Welcome back, investors. Today we have started our new series where we will create short summaries of top finance and money-related books. And for the first episode, we will start with the Bible of the investing world, The Intelligent Investor by Benjamin Graham, published in 1949. Benjamin Graham is known as the father of value investing and was a mentor to Warren Buffett. He describes core investing principles in this book, and any investor, whether he is a beginner, intermediate, or an expert, must read it. This summary aims to explain the main principles from the book. Before we dive into the details, smash that like button so the videos will reach to a broader audience. And also subscribe to our channel to get notifications while we post a new video. Let's get started. Graham invented the famous term, Mr. Market, and he describes it as a person who will come to your door every day offering you a price to sell your stock. As he's a sentimental guy, his price may well be above or far below the intrinsic value of the company. One should avoid opening doors to Mr. Market, as prices are just emotions of short-term traders and does not reflect the value of the company. Graham categorizes investors as two types, the defensive investor and the enterprising, aggressive investor. Defensive investor, like the name suggests, is someone who doesn't want the stress of investment analysis in his life. These type of investors are not willing to spend tons of hours analyzing stocks or investment instruments. They're willing to spend that time somewhere else. Defensive investors are willing to settle for average and does not like the volatility of the market. In today's world, they are called passive investors. They invest in a broad-based index fund and holds it for a long period of time. On the other hand, aggressive investors is someone who likes the ups and downs of the stock market. They love to analyze and find companies that would potentially give them huge returns. They are also called active investor. Aggressive investors often take bigger risks than defensive investors and aim for higher returns. But for this, they must actively monitor their stocks. So, what are the criteria that Graham suggests for these two types of investors? Well, for a defensive investor, a company must have annual sales of more than $100 million. Take note that this is in 1949. $100 million in 1949 is equal to $1 billion today. So annual sales more than $1 billion. Current assets should be twice of current liabilities. This is also known as current ratio. There must be earnings growth for the past 10 years. Consistent dividend payments for at least the past 20 years. Price to earnings ratio, or in short, PE ratio, should be less than or equal to 15. Current price must not be more than 1.5 times the book value. An alternative way is to just buy and hold an index fund like the S&P 500. For aggressive investors, a company must have current assets 1.5 times current liabilities. Debt should not be more than 110% of the net current assets. Current earnings per share should be greater than 5 years ago. The company should be paying some dividends. Price-to-book ratio should be less than 1.2. PE ratio must be cheap. What about diversification then? Well, for both investors, Benjamin Graham suggests a portfolio of around 10 to 30 stocks. And to be more conservative for passive investors, he suggests a portfolio of 50% bonds and 50% stocks. Finally, there's a margin of safety factor. This can be explained through an example. Imagine that you're building a bridge for people to cross. You know the average weight of the person who crosses the bridge is around 80 kilograms. Now, would you construct a bridge that can withstand just 80 kilograms? Or would you rather build it to withstand up to 120 kilograms? Obviously, you would build it to withstand 120 kilograms because you know the former is stupid and risky. The same scenario applies to stock. You may be able to calculate the intrinsic value with different methods, but ultimately, it is just a calculation. There's a high chance that you're wrong. So, to play it safe, Graham suggests to add a margin of safety of 50%. The riskier the stock, the higher the margin of safety. You also need to ensure that the company has good management. Here comes the qualitative part of analyzing stock. Ask questions like, does the CEO care about the company, or does he just want to make some big money? What does the company executive say? And do they do what they say? Read annual reports to see forecasts and if they fulfilled them or fell short. Are they competitive? What is their motive like? Do they have protection against competition? And look out for insiders consistently selling shares. This will help you to determine if the company is in good hands. Now, if you are watching the market, following stock prices, and then placing value on its movement, you are speculating. As Graham says, in our own stock market experience and observation, extending over 50 years, we have not known a single person who has consistently or lastingly made money by following the market. We do not hesitate to declare that this approach is as fallacious as it is popular. Although some speculation is necessary and unavoidable because there are great possibilities of both profit and loss. The task is to keep risk within limits. It's like a unique kind of casino. You will not lose in the end as long as you stick by the rules that put the odds in your favor. Note that Graham was entirely against speculating. He says that while it can be fascinating and fun, you should never mingle your speculative account with your investor account. And you should never put more than 10% of your money into this mad money account. Finally, Graham says that when you are buying a stock, think like you are buying the entire business. If you are not comfortable in buying the entire business, then you should not own that stock. So that's it, folks. Those were the key points from the book Intelligent Investor. This summary by no means should be a replacement for the book. If you get an opportunity to read it, we highly recommend you do so. Hope this video was helpful. If you have any questions, ask in the comment section below. And if you like this video, give us a thumbs up, as it really motivates us to create new videos. Also, subscribe to our channel to get notifications while we post a new video.